Okay, good. So today we will be talking about strategy backtesting. So we'll cover why backtesting is important, an overview of the strategy development process, choosing the backtest period, and finally some of the issues we can encounter when performing backtests. So feel free to post some questions in the chat throughout the webinar. I'll get around to them at the end. Good. Okay, so to begin, let's talk about what is a backtest. Some of you already know what this is, but for those new guys, it is three key parts to describe it. It's an important part of the strategy development process to test the viability of a strategy. So how likely is this strategy going to be successful in live trading? Next, it involves simulating the performance of a given strategy on previous price data. So if we go back in time and test a strategy on previous prices, how would it have performed? And you can involve a manual or automated backtest process. So we'll go into both of those a little bit later. But there's two types of ways we can do a backtest. So why are they so important for us as traders? So firstly, they allow us to assess how well a given strategy would have performed on previous price data. Okay, so would this strategy that we're currently using, would it have been profitable over the past 1 to 3 years, for example? We can assess the max drawdown, total return, number of trades in any given period, and many other performance metrics that will give us a good idea on how this might perform going forward. It also helps us to build a picture of its strengths and weaknesses. So now we have all these performance metrics that we have, as we just mentioned, max drawdown and all the others. We can know how we might want to improve this strategy going forward, considering its weaknesses and what makes it a strong strategy. Performing backtest also gives us a guide to what future performance might look like, right? So might is an important part in that sentence. As we know, past performance certainly doesn't guarantee future performance results, and it's important to bear in mind when you're backtesting. But it gives us some kind of guide as to how it might perform going forward. And finally, performing a backtest helps us to either reject, improve, or approve a strategy for trading. So depending on how the backtest performs, we might decide to make changes to the strategy or change the strategy altogether if we don't see positive performance that we're looking for. Okay, so here is a typical strategy development process, starting from observing data. So this could be price data, volume data, whatever type of data you want, and ending at the forward test in the bottom right. So it's important for you to understand what a thorough strategy development process should look like when developing a strategy, even if you're using one of our Alphachain strategies. I think it's good for you all to just get an idea on what's involved from each step. So when developing a strategy, a significant part of the process is usually spent in the research phase. So that's the 3 boxes above the dotted line, just up here. That's where the majority of the time is usually spent. So defining your hypothesis to test based on your market observations. So a simple example of a hypothesis could include observing strong momentum in the Bitcoin price, which leads to large trends evolving over the long term. Therefore, you might feel, as this is a trending market, I want to try out a moving average strategy on this type of market. And other markets might have certain other characteristics that might be better attributable to other types of strategies. That's just an example of some observations you can make and a strategy you would apply based on that observation. After defining your indicators to test based on your market observations, you can then move on to developing your trade plan. So down here. The trade plan defines your trade criteria. So what criteria you want to see in order for you to place a trade. And if you're a systematic trader, so you're trading via code, here you would code your rules-based strategy. Okay, so at the beginning, we've observed data, we've formed our hypothesis, we validate that hypothesis, and this is usually done through statistical analysis. But most of the things we do here at Alphachain are below the line because you have your predefined strategies. However, if you are someone that wants to define your own strategies, these bits above the line will certainly be important to you. So once that you complete your trade plan, you then move on to your backtests, which is here. So you're doing this to test the viability of your strategy. Now this could be manual or automated. Again, we'll touch on that a bit later. Depending on the results of your backtest, you might ditch the strategy completely or make small iterations before backtesting again. So define our trade plan, then we move forward to a backtest. If we're still not happy with how performance is, we iterate back again to find a new trade plan, a new idea, and again, we go back into this backtest right here. Once you're happy with the results of the backtest in the sample, you'll then move on to a forward test where you begin to test the strategy on live market data in real time. So the idea, this is an iterative process. We are defining the plan, looking at the backtest, assessing the results, and you repeat that until you're happy. When you're relatively happy, you'll then go live test this on forward data. Now that's an overall summary. As I said, most of you will be looking at the boxes below the line, the post-research phase, but I think it's good for you guys just to get an idea of what's usually involved when defining a strategy. Okay, now let's delve in a bit more into the backtest process itself. So something I always like to do with my backtest, and I recommend you guys all do yourself, is splitting the backtest data into two parts. So in the first part, you allocate approximately 70% of the backtest data, where you use that data to test the viability of the strategy. So some of you who have reached that part in the course already know that we look for around 100 trades per asset, and we want those 100 trades to make up approximately 70% of your past data. If you can do more trades, then that's great. The more trades you have, the more data points you have, the more reliable your output will be. And again, you can iterate changes on that if necessary, repeat back through backtesting on the same data again until you're relatively comfortable. But it's one thing to note in that first part is you have to be very careful not to try to fit the strategy too closely to that sample data. As we mentioned before, history will not repeat itself. So we know the previous prices and previous data will not be exactly the same moving forward. So we don't want to make our strategy too complex. We don't want to fix it too closely to those data points. Otherwise, when we trade in live markets, the results are going to be very different to what we expect. So at the end of the first part, if you're happy with the performance, then we move on to the second part of the sample data, so the remaining 30% of the past data. Now this is where you've basically defined your strategy in the first part, you've made any alterations, and you just do a minimum of around 40 trades on the remaining part of your data. So for example, to give you some kind of idea on what I mean here, imagine you have 3 years worth of backtest data you want to backtest your strategy on. The first 2 years you might allocate as your first part. So you allocate 2 years to your 70% worth of past data. That's the 2 years that you work on your backtest. When you're comfortable, then you've got that last year to do some backtesting on without any iterations. And the question is, why do we split the backtest in two like this? What's the point in doing that? So we want to avoid something called overfitting. Now we'll cover overfitting in a few slides' time. But to mention it briefly here, this is where we fit the strategy too closely to previous data, resulting in backtest results which are likely to be very different to real-world performance. So by splitting the backtest data and only using the first part to make the amendments, the test on the second selection of data is free from any bias that we might have put into the strategy from the first part of the backtest. So I hope that makes some sense. And once you're finished with that, then you're happy to move on to the live data, which is your forward test. So breaking down your backtest into two parts is something I recommend. We can help you with that moving forward if you've got further questions. So manual versus automated backtest. So both types of backtests can be useful, and they're useful for different types of traders. So there's not really one that is better than the other. They both have different purposes. So for a manual backtest, if you're a discretionary trader, which I think all of you are, definitely the vast majority, you'll be executing trades manually based on your predefined trade plan. Therefore, it's essential that you perform your manual backtest. And this is important because we want to simulate the backtest as closely to real-world execution as possible. So in practice, this will involve using the TradingView replay button. Some of you may know what that is already. If not, you'll know very soon. And this is used to simulate live trading on previous data. It ensures that you're running the backtest the same way you would be trading live, so that the backtest results should be more reliable. Okay, so if you're a discretionary trader, we don't really want you performing an automated backtest that will automatically execute your trades because you'll be executing them manually. So you want to mimic the exact way you'll be trading in real life. Now, an automated backtest can be used for systematic and discretionary traders, in addition to your manual backtest if you're a discretionary trader. When developing a trading system, it's essential that an automated backtest is carried out to test the trading system. So an automated backtest is essential for those that are developing systems to test the system on previous data, the same way it would execute on live trading data, right? So if we have an automated strategy that automatically executes its trades in the market, we want to ensure that a backtest mimics exactly the same environment. A manual backtest is less needed for systematic traders. However, it can be beneficial depending on how the strategy is executed. For example, if trades are executed manually, but they are based on an automated signal from your model, from your system, then it makes sense that you might want to add a manual backtest in addition to your automated backtest to help simulate live trading more closely. So as I said, one isn't better than the other. It depends on what type of trader you are. Ultimately, we just want to mimic what you'll be doing in real life in live execution. So this is arguably the most important slide, I think, for all of you guys that are performing backtests. So some of the pitfalls that we need to look out for when backtesting. The first is transaction costs. So it's important to consider your transaction costs, such as trading commissions, when performing your backtest. Certain types of strategies sometimes appear to be profitable initially. However, once taken into account trading commissions, they have become unprofitable. Now, this isn't that common, but it is important to consider trading costs in your trading strategies, particularly if you have a strategy that trades more often and therefore will incur more trading commissions, more trading costs. That's something to bear in mind. Next is manual bias. So many of the junior traders that come through the trader program seem to have very profitable backtest results. Now, the probability of this being accurate is fairly low. There should certainly be a much higher number of you guys that are having negatively performing backtests. And the reason for that is because everyone interprets strategies differently. You're all trading slightly different strategies based on which of our strategies you're choosing. And you all have slightly different execution techniques. So the reason why we see so many new traders have really positive backtest results is usually due to manual bias. This is where many of you will actually try to skew your backtest results to make them seem better than they actually are. So for example, in practice, this will mean you adjusting a trade entry slightly to show a winning trade versus a losing trade. Now this is human psychology, right? When we're doing a backtest, we're investing our time and effort, and backtests can take a lot of time, especially when you're manually doing them. So therefore, we have an incentive to ensure that the performance is good from this backtest. Now, this can actually make the whole backtest process completely unreliable. Okay, so it's therefore very important to completely follow your trade plan to the T when backtesting. If you've done this, then you can be fairly confident that results are reliable. But if you're adding in a sense of bias into your backtest, you're changing the data essentially, moving your entries to make the performance look better, then it is going to be a complete waste of your time because the output and the data you've got from that backtest isn't going to be reliable. Third is the time of day of your trades. So when performing your backtest on TradingView, you want to ensure you're only taking trades in the same time window as you would in live trading. So for example, including trades that occur overnight when you are unlikely to be trading overnight will lead to unreliable backtest results. So again, if you're only the type of trader that will trade between 7 and 4, well then make sure in your backtest your trades are only between that same time period to ensure that your backtest is as reliable as can be. Okay, 4 is sample size. So it's important that you ensure you have enough trades in your backtest to form any meaningful results. We recommend at least 100 trades per asset. And the more data points you have, the more reliable your backtest performance will be. I think that's fairly obvious. So if you had 5 trades in your backtest, that performance could be massively skewed by any one of those individual trades. Whereas if you have 100 or over, there's less chance of any individual trade skewing your results. So that's an important thing to bear in mind. 5th is market structure. So I recommend splitting your backtest periods into sections to ensure you're covering different types of market dynamics. So for example, including a period of risk on and risk off themes, I think will be important in your backtest, as well as any other volatile scenarios such as recessions that you want to test as well. Ultimately, this is a strategy that you'll be trading for quite a long while in different market dynamics. So I think it's good if you try and include some of those within your backtest. Now, times such as recession, so we have some volatility over the past couple of months, particularly in March, you would want to include maybe a small portion of that, but these are rare events, therefore you only want to include a small part of your sample data in them. But I think it's important for you to see how your strategy would cope in those environments. And finally is overfitting. We'll discuss this on the next slide. So when developing a backtest strategy, we should always look and be aware of the risk of overfitting. So we've mentioned this a couple of times earlier on in the presentation, but it is a very big issue in backtesting, which many people aren't aware of. So overfitting is when you're fitting a strategy too closely to historic data points where the backtest performance is not likely to represent real live trading performance. So we mentioned that before. So if you're fitting it too closely to previous data, we know previous data isn't going to repeat itself in exactly the same way. Therefore, the performance may look fantastic in a backtest. Great, that looks fantastic. But in real life, it's going to be very different because those price points aren't going to repeat itself. And you've overfitted it to previous data. So a few tips to take away to kind of help with overfitting. Keep the strategies relatively simple. Okay, so the more complex your strategy is, the more chances you've overfitted it to backtest results. So keep it relatively simple so that it can be nimble and can work well in various types of market. As we mentioned, sample size is important. So have a large number of trades in the backtest. That'll certainly help to include more market dynamics, more differing market structures in your backtest. So to see how your strategy will perform in different times. And as I mentioned earlier, backtest on only a sample of the backtest period first when developing a strategy, and leave a little bit out for validation, just to ensure you're not overfitting your strategy too much on the data on the backtest. Okay, and that's pretty much it. It's a short and sweet webinar.